Today we're going to talk about how trusts are taxed. We're going to talk specifically how trusts as entities have much higher tax burdens due on taxable income than non-trust accounts. And we're going to talk about how, as the creator of a trust, you're probably not going to care. Now, when I talk about trusts specifically, there are different kinds of trusts, and also this is not to be considered estate planning advice. Get help from a professional who knows your situation. But when we're talking about trusts specifically today, we're talking about revocable living trusts. These are the most common. Now, this is the kind of trust you would set up for your beneficiaries, your kids, your grandkids, that allows them to, pull funds in the future after you pass away and have controls around divorce protection, creditor protection that we've talked about in past videos. So specifically, this is a revocable living trust. I would say probably the most common you're going to see. And this is different than trusts as an entity. Now, so what do I mean by that? Well, before we start talking about that, because that's really important, let's talk about trusts as an entity's tax rates, because I mentioned they're quite a bit higher. So let's look here. If you are not in a trust, and if your accounts are not in a trust and they're just taxable income, these are the 2024 tax brackets. Now keep in mind, the brackets will change over time, so depending on what year you're looking at this, these numbers may adjust some, but you're going to be able to get the point. So the numbers here are, you're starting all the way from 0 to 23,000 in taxable income. It's 10%, and then it continues to go up into the top tax bracket of over $700,000, gets you to 37%. And so what does that mean? It means in order for you to get to the 37% tax bracket, you have to be making over $700,000 in taxable income. Okay, that's for individuals, non-trusts. Well, how are trusts taxed? Because say, hey Kyle, you said trusts were taxed at a higher rate. What does that mean? Okay, well this chart here looks at the taxation of trust as an entity. And so what you can see here, these numbers, the 10, the 24, the 35, and the 37, those are familiar numbers from your individuals or from family trusts. However, it escalates much more quickly. And so what you can see here is that $15,000 in taxable income, that is the most that you can earn before you move into the 37% tax bracket. And so taxed as a non-trust, you can make over $700,000 and not get taxed at the highest income bracket. Taxed as a trust, you're at $15,000. Those are huge differences when you're thinking about the tax liability of an account. Now, in the beginning of the video, I said, and as the creator of this trust, you may not care. And the reason is because when you create a revocable living trust, the idea that it is revocable and that you can change it means it is in your control, and the way the government views that is it means those trust tax liabilities are going to flow through as the grantor of that trust to you. And so when it's in a revocable living trust and you are alive, this is just going to be your tax liability. And so it's going to go back to that $730,000 tax bracket rather than the trust tax bracket. That account will not move into the trust tax bracket until the trust becomes its own entity and becomes irrevocable. So at your death, right, or at you and your spouse's death, your beneficiaries will then have a trust as an entity, an irrevocable trust for their benefit. And in that situation, they are going to need to be more careful and more aware of how to build portfolios that are more tax sensitive because the income tax brackets are so high. And so as the grantor of the trust, doesn't really matter to you. It's not going to impact your taxable liability. But as your beneficiaries, once that goes from a revocable living trust into an irrevocable trust for their benefit, they are going to have trust taxes as an entity, which is a much different game. And so for your beneficiaries, they're going to need to understand how income works, how tax-free income works, how dividend income works, just so they fully can minimize the trust taxes that are due. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.